Good afternoon, ladies and gentlemen. Well, it's just after 12 noon Eastern Time here on the East Coast. Welcome to today's presentation, Credit Spreads, Just the Basics. For those of you who don't know me, my name is Michael Chupka. I'm the Director of Education here at Power Options, and it's great to see you all here. What are we going to discuss today? Well, in today's session, we are going to discuss the basics, and the basics only of credit spreads. This came about because we have many archived presentations on Power Options and available on YouTube related to different option strategies, management techniques, and more. And about a week or two ago, a comment came in from one of our older presentations comparing debit spreads to credit spreads, breaking down the basics of the four structures, and discussing parity. Well, the comment was, of course, why can't we just do a separate and easy one to just discuss credit spreads? Why go into all the detail? So here we are just to discuss bull put credit spreads and bear call credit spreads for an option strategy. We're not going to talk about the debit spreads, combinations, Iron Condors, Iron Butterflies, or anything along those lines. So why would we use credit spreads? Well, a credit spread is a leveraged position. Allows us to take advantage of leveraged monetary requirement for a trade, and it comes with a known low risk. No stock is owned, no stock is shorted. We receive a premium up front for combining two options together, one sell and one buy. We can structure it with the various options we have to be bullish or bearish, depending on our outlook of the market or our outlook on a particular security. Properly structured, we have the comfort of a high probability of success with either a bull put or a bear call credit. Other advantages of the strategy is they can be traded weekly. We can use 7-day out, 5-day out options, or even many times during a week. If you follow SPX, SPY, or some of the other broad-based indexes, there are actually options that expire every Monday, every Wednesday, and every Friday. So you could do as much as 3 credit spreads in a given week. Of course, we can still do positions that are 2 to 3 weeks out that give us a better net credit with a similar structure, or even go far term, go monthly or even more out in time. The spreads can be managed if it moves against you, and we can actually better diversify due to the lower margin requirement of a credit spread. Let's say in your portfolio you have $5,000 that you want to put into some trades. Well, if you bought a $50 stock, you could buy 100 shares and sell a call, enter a covered call position, but you've allocated that full $5,000. If I set up a spread that only has a $200 or $500 margin requirement, we'll talk about that in just a moment, well, I might be able to open as many as 10 spreads, 5 spreads, depending on the number of contracts I need to make it worth my while. Another advantage of the spread positions, again structured properly, is the stock can stay at the same price it is right now through your expiration. It can move in your expected direction, or it can even move slightly opposite, and you can still receive the maximum return. Well, if all of this is available for all of us options traders, why isn't everyone trading credit spreads with a large portion of their portfolio? Well, some disadvantages do exist. Spread positions can result in large losses if you're not disciplined or in the event of a sudden market shift. If you allocate a large portion of your portfolio to spread trades, you may also see wide portfolio swings. If you pick the direction right over a 4 or 5 month period and everything is looking good, you may see your portfolio gain 20 30%, maybe even more in that 5-month period. If there's sudden swings in the market, volatility, sudden things changed, expectations changed, you may actually see a decline in your portfolio or the money you allocated to spreads of 30, 40, or 50%. Another disadvantage, whether you're in a bull put or a bear call, but specifically in the bull put, you could end up having to buy stock in a certain situation. In a bear call, you could end up being short stock in a certain situation as well. The obligations of selling and buying the options individually don't change just because you're in a spread. We do have a net that controls that risk, that known risk that we know going into the position, but we still have entered an obligation to perhaps buy or perhaps short stock depending on the structure. So what is the basic structure? Let's start with bull puts. And with Apple trading at 152 today, I might look shorter term, 10 days out, 14 days out, maybe even less. But what I typically want to do is sell an out-of-the-money put, a put option that is below the current stock price, and at the same time, I want to buy a put at a lower strike that is further out of the money. This allows us to receive a credit. And as long as the stock stays above both strike prices, well, specifically the sell option, but it stays above both strike prices, both options expire worthless and we receive the full profit. That is the goal. Here we see a quick example of Apple trading at 152.42. What I may enter if my sentiment was bullish on Apple over the next 10, 12, 15 days is we may sell the 144 put for the 18th of January expiration. We're going to take in a premium of about 70 cents. If we did this alone, it would just be a naked put. And we'd have to maybe put up the full margin requirement to buy shares of stock at 144 at our broker. To save us that margin requirement, we're now going to take that 70-cent premium and we're going to use it to buy a lower strike, in this example, the 142 strike put for only about 47 cents. This means the net that I take in is 23 cents. I've sold the 144 put, which does obligate me to potentially buy shares of stock. But in case something unexpected happens and Apple gaps down to 138, 137, 135 or lower, we purchased the 142 put, which gives us the right to sell shares of stock at 142. So the most I can lose in the absolute worst case scenario is the difference of 2 points per contract, $200. However, since I took that 23 cents in up front, my broker may only charge me $1.77 per contract, or $177, and I may lose that if the stock falls below the lower strike price. However, due to the margin, only truly risking 177 and looking to receive 23 cents, we receive a 13% return on investment if Apple stays above 144 in the next 9 days and both puts expire worthless. That is the goal of the credit spread position. Now, why this spread? When I enter a bull put or a bear call, any credit spread, I want to be out of the money with the short option to have a better probability, theoretical probability the stock will stay above that strike in the next 9 or 10 days. In this case, the January 144 put has an 85% theoretical probability based on the past trading range of the stock that in the next 9 days it'll be above $144 per share and I'll receive my maximum profit. You can also look at it based on delta The short put has a low delta of negative 0.13, or what you might say 13. We're out of the money because we want the better probability, 8.5 out of 10 times, or 8 out of 10 times if we looked for an 80% probability, that our positions would expire worthless. By selling the 144 put, this means the stock can fall almost 8 points before the trade is threatened. And we of course purchased the 142 in order to give us that lower margin and only have to put up $177 or $200 requirement per contract. And again, if you did 10 contracts, it'd be $2,000. Okay, now, if we look for positions out of the money that have this good probability, why don't we go further out of the money? We see at the top here the spread we showed with the 144, 142 strikes for a net credit of 21, 23 cents, 10, 11, 12% return with the 85, 86% probability. Now I could go with a higher probability, up as close as 96, 97%, and with a stock at 152, almost at 153, I could sell the 139 put for about 22 cents, midpoint, and buy the 137 for about 15. Well, this is only going to give us a net credit of 7 cents. It's still a 3.6% return for 9 days. But how many contracts are you going to allocate? In this case, on a 2-point spread and receiving 7 cents net credit, that 3.6% return is a 7-cent credit over a risk of 193. How many contracts do you need to trade of a 7-cent net credit to make the commissions worth your while, to make the return worth your while? I may have to go as high as 10 contracts, maybe even 20. But then that's 20 contracts times the risk. That's almost $4,000 to make 70 cents or $1.40 if you did 20 contracts. It's still a 3.6% return, still has a 96% probability. Very good cushion for the stock to drop. 14 points before your spread is threatened. But now, is the money worth it? That's an analysis that you have to make yourself based on how much money you're allocating to spreads. Are you going to diversify in the spreads in your portfolio? And what are your personal goals for return on investment, whether it's a 5-day, 14-day, 30-day trade or more? There's sort of a sweet spot, and personally I think the sweet spot is sort of between that 80 to 90% probability range, where we can still see 8, 9, 10, maybe 12% return over a 10-day, 14-day period. Okay? So I show here a 2-point spread, comparing even 2-point spreads with what you see as the net credit versus the probability and the return on investment. Well, if I'm getting 22 cents here at the 139, couldn't I pay less of a cost for a lower strike put? Instead of doing 2 points apart, maybe going 4 points apart, 5 points apart. So I'm paying less for this to get a higher net credit. Well, as with everything in options trading, there's a trade-off. You can use wider strikes naturally. You can use any strike combination that you want, but it has to match your goals. Here we see the same structure of selling that 144 put for January 18th expiration with a 5-point strike difference, buying the 139 for only 24 cents instead of buying the 142 for about 47. We're paying half the cost, which means instead of getting a 23-cent net credit, we're taking in a 46-cent net credit, double the premium. That looks pretty good. but the risk has moved from 177 to 454. That's 2.6 times the risk. Thus, we're only seeing a 10% return with the same 85% probability that the stock will remain above 144. And if I'm only allocating $2,000, I can only do about 3 or 4 contracts of this spread. Whereas at 177, if I'm allocating $2,000, I could do maybe 10 contracts. So there's a trade-off there when you look at it to analyze, is the increase in risk worth it to double the net credit? Because at the end, we still want to see a good return. In this case, we have the same probability, 85% delta of 0.13, but the return is lower because the risk increase is higher than the increase in the net credit. This is not a bad spread. 10% for a 9-day trade with an 85% probability. But the structure of the strike difference, once you've decided your range of how deep out of the money, what probability or delta that you want to use for the short, the swing position, the difference in strike selection now has to be based on what is your return goals for this portion of your portfolio, and does the increase in risk balance out the benefit you're getting of the increase in credit. Okay, so a lot of times I feel that going to a 5-point spread or a 10-point spread might not be worth it. On a side note, I have investors I've talked to recently who have had positions on Tesla with 40-point spreads to try to get a $2 net credit with an out-of-the-money put, maybe selling a 305 and buying a 265 further out in time. Well, that again might be a lot of margin requirement to receive $2. You might be as well off doing a 5-point spread, only putting up $500 and still making 50 cents. But again, that comes down to personal preference and your goals for the return on this strategy in this portion of your portfolio. Well, if we're talking about increasing strikes, we usually see that the increase in the risk doesn't balance out the increase in the net credit. So that would mean a smaller strike difference must be better. A lot of stocks now that offer weekly options offer 1-point strike differences, maybe as much to 5 weeks out in time, every expiration 5 weeks at a time, or even a 50-cent point spread. So if I can get a 5-point net credit on a 50-point spread, isn't that still the 10, 11% return that I might be looking for with a good probability? Well, sure. It also gives you a lower monetary risk of, say, only 45 cents. Now you have a lower net credit of 5 cents. So how many more contracts are you going to need to trade to make the monetary gain worth it for the money you want to see coming in, to cover the commission costs, so the commission costs of entering the spread position don't take too much away from the net credit you received? As an example, same Apple position, same 144 short put with the 85% probability. I could do a combination with the 144, 143 strikes for January 18th expiration. This would be a 12-cent net credit, which is a 13.6% return because the true risk is only 88 cents. Well, the 12-cent net credit is not quite half of the 23 cents we would have received on the 2-point spread. And the risk of 88 cents, well, that's essentially even the half of the 177. So for the same 2-week period, 10-day period, we're almost looking at the same. We're getting a little bit more bang for the buck here. 12 over 88 as opposed to 23 over 177. 13.6 versus a little slightly lower return, but still double-digit return. Right now we don't have a 0.5 spread. So this is comparable. And this is still a good spread because of the return and because of the probability. There's nothing really wrong with doing a 1-point spread. But now how many contracts do you have to trade? If I was planning on trading 4 contracts of the 144, 142, I might need to trade 8 contracts here to get the monetary value I want. Right? That 88 cents, 96 cents or so, same as doing 4 contracts with a 23-cent net credit on the other spread. So again, you can use the smaller strikes. Personally, and this is personal preference for me, I prefer 2 strikes apart or more when structuring that spread. The 144 to the 142, leaving the 143 in between. Why? If I do have to manage the position, I have a potential extra management. If I'm wrong, Apple starts to move against me and threatens the 144 strike, I may be able to buy to close the 144 and just roll down to the 143, even with a few days left. It gives me a little bit more cushion. It still might be a positive return. Might be half of what I originally expected, but now with a couple days left, if Apple's trading at 144.50, I'm worried that it might drop below 144. I move that 1 strike down to 143 and I'm still holding the 142. That's still my spread. So as long as now Apple stays above 143, I can still call this spread a success. If I do the 1-point spread, the 144 and 143, I don't have that. Once that spread is threatened, I'll have to close both legs and look to maybe rolling down the spread. I know I said we weren't going to talk about management, but this is one of the basics of why I personally prefer to keep 2 strikes apart. But it is personal preference. You can do the 1 strike difference to see that lower monetary risk, that lower margin, or you can do 5-point spreads to get the higher net credit. It just has to match your goals. Now, could I go closer to at the money, closer to the current stock price if I was really bullish on the security I was looking at and I felt there was no way it was going to drop below 150 and so I should just do better? Well, you can. But again, selling the 150 put, buying the 148 is going to give me a credit almost triple of what I was talking about with the deeper out of the money spread. We're looking at a net credit of 59 as opposed to 23. Let's call it 60 cents. That means my true risk is only 140, so we're looking at about a 41, 42% return. But now with only a 60% probability that the stock would stay above 150. Only about $2.85, $3 from where it is now. We know stocks fluctuate in price. So that's the trade-off. I can go closer to at the money with my short option. I can get the higher premium even on the same comparable 2-point spread. But again, I might only be right 6 out of 10 times. I want to be in a position where I'm far enough out of the money that I'm looking again at that 75, 80, 85% probability or higher of success. The goal is to have a high success rate, to have both options expire and make the maximum return, with the combination, of course, of doing that as well. Doug, I'm just going off the numbers here. Okay, the computer, the power options tools are calculating for me. You say, how do you only see a 60% probability? Sorry if I didn't highlight it there. So here's the probabilities we see. 64% theoretical probability the stock would be above the short put at 150. If I did the 147, 145, it's a 23% return, and there's a 77% theoretical probability. I let the power options tools do the work for me rather than calculate it myself. Okay, but that's the trade-off. Can you get a 1-to-4 risk to reward ratio with credit spreads, or even a 1-to-2? Yes, but you're going so close to at the money that you only have a 50 or 60% probability of being right. And as anyone will ever tell you, any webinar you've ever seen, people will tout the high success rate. I personally don't. Okay, I'm not going to claim you're going to be right 80 to 95% of the time on your spread positions. I have a structure, I have a default settings that were right the first 7 to 8 months of 2018, 92% of the time. But we didn't want to be doing bull puts through October, through November, or December, did we? In fact, if I had continued doing that, continued following that criteria set for bull puts during that time frame when the market was going negative, the bull put return rate using the same criteria of the 12 months, the success rate would have only been 71% of all trades throughout the year. I want that to be higher. I need that to be higher with these structures in order to profit long term. So what do we want to look for? Well, with a bull put, I want to enter a bull put spread on a stock that I feel is bullish, that is strong, neutral, or moving up in price. I want to see a stock in an uptrend and also has good fundamentals and maybe some good technicals. I want a spread that is out of the money, where the short put is 1 or 2 strikes below the stock price if I'm going only 7 days out or 14 days out. If I'm going a month out, I'm standing, let's say, February expiration up to 40 days out in time, I might look for 3 or 4 strikes more. Little bit better safety, more time in the trade, but I can go further out of the money, have a much lower break even. So I want to be out of the money. I want to look for that higher probability, 80% or more usually, and maybe a low delta. I personally don't use the delta. I use the probability myself, but you can look for delta if that's what you like as well. I want a spread width that is manageable. A 1-point spread carries that much lower monetary risk, but you need to trade more contracts to avoid the commissions hurting you too much. A 1-point spread can cause quick losses. If the underlying security you're tracking, that you have a bull put spread on with a 1-point or a 50-point spread, has a sudden 4 or 5% decline, which we've seen numerous times in November and December of 2018, that drop might push it below both strike prices, and I'm at the maximum loss before I have a chance to do any management. I want to keep maybe 2 strikes apart, maybe even 5 strike difference. Now 10-point spreads are higher, as we talked about with that Tesla position of a 40-point spread. That might be too much risk for your portfolio, too much margin requirement. However, if you wanted to look at, say, indexes, if you wanted to trade a spread on SPX or NDX, you may only have the choice of a 10-point spread or more because of the higher underlying prices. Amazon, for example, might have a 10-point spread or more just to start with, nothing smaller. And just like with any other option strategy, in general, when we're selling premium, covered calls, naked puts, even Iron Condors we're not going to talk about, but in general I want to be shorter term. Why? Because if I'm able to sell every 2 weeks or every month, I'm going to get a higher annualized return than selling 6 months out in time, even though the premium is higher 6 months out. It's not 6 times the cost. Okay. Michael brings in a question to management, and I'm going to address that right now. We're just going to talk about that. I didn't want to get too in depth because we wanted to just talk about the basics. We have a full webinar, of course, on the management of bull put spreads, bear call spreads, and more. Michael brings up an interesting point. He says with a 1-point spread, this is our 2-point spread I'm showing you again here on the chart, but with a 1-point spread, can I just buy back the short put and keep the long put open? Absolutely. So if I was in the 144, 143 spread with the lower return, if the stock starts to fall, I could buy to close the short and leave the long open. That's dependent on the stock continuing to fall. Okay? What did we see just last week? I'll give you an example of Starbucks real quick. I was trading the Starbucks position. It's a different structure, but I was in Starbucks, and it dropped $2.85, I think, down to about $61 on Thursday. And then on Friday, it moved up to $60. Okay? If I'm in a weekly spread and this happens, and I buy to close the short that expires in one day and leave the long open, what am I paying for that short, let's say the 62 strike? It's going to cost me $1.40, $1.50. But remember, with the 1 point spread, I only took in maybe 12 cents. So I'm at a loss of 138, a debit now of 138. Only see the next day on expiration the stock go back to 260 where my spread would have been successful. If you have time, Michael, stock blows below or hit starts threatening the short, you buy it back. Just remember what you're paying for the at-the-money strike versus the smaller net credit you received. If it does continue to drop, the 143 might gain in value to counter that. But if it recovers before expiration and moves back up, you've doubled your potential loss on the trade, maybe even tripled it. Okay? That's part of the risk of management, as you know. And the other thing I wanted to mention, let me go back here, I'm sorry. Oh, yeah, there we go. Going back here to this position here, one of the reasons why I like the 2 point spreads there is so that I have the ability just to move it down one strike. But you're absolutely right. If I have 5 days to go in my spread, 8 days to go, something went wrong in the market and it starts to move against me, and either my 2 point spread or the 1 point spread or the 0.5 spread that you're mentioning, Michael, that is one of my 8 ways to manage a bull put. I may consider just buying to close the short for that extra cost if my expectation is it's going to continue down, to just leave a long put open. You can absolutely do that, but remember you took in less up front for the 1 point spread. The buyback cost of the now at the money or slightly in the money short put may be too expensive. Okay, got off track there. That section, that 2-minute, 3-minute discussion there just probably blew away the idea of just being about the basics. But anyway, that's what we look for. And this is what is shown for the criteria that we use on our weekly bull puts and power options. First particular reason, we prefer to look for spreads that expire about 2 weeks out in time, 8 to 17 days out in time. I want a net credit of at least 20 cents. Don't want to trade a 3 cent, 4 cent, or 5 cent net credit. Naturally, we want a good return up in that 6, 7, 8% range, maybe 10% if we can find it. But I still want to be out of the money. I still want that high probability. I want to control things and limit things that have a very wide bid-ask spread that likely come with options that have a higher implied volatility due to recent news or recent fluctuations in the stock. At the same time, I want the basics. I want a stock that's trading in an uptrend. You can use EMA, but I prefer to use the SMA 20, and maybe some other technicals such as a stock with a positive MACD. Always avoid entering a spread where your underlying security has earnings between now and expiration. Of course, I showed you too, I'm sorry, the greater than $2 in the strike difference. This is our default bull put weekly search on power options, and this is actually what I use in the portion of my portfolio that I allocate to credit spreads if I'm looking at bull put spreads at the time. Okay? But of course, there's multiple ways to enter it. You can create your own search in power options, but what would you look for? Can you use standard ETFs that are less volatile, don't tend to have fluctuations due to an early earnings warning event, potential takeover rumors, pending patent lawsuits, or anything like that? Absolutely. Those can be good candidates for spread positions, as can the indexes which we talked about, but you may have to use that 10-point spread or wider depending on the index you're looking at. You can choose to screen just against ETFs and indexes for spreads that have your desired 6, 7, 8% return for a 5-day trade, 10 to 15% for a 14-day trade or beyond, that still have an 80 to 85% probability, reasonable net credit of 15 or 20 cents, and that reasonable return maybe of 9%. And you can also set the expiration if you want to see just weeklies or you want to see longer term. But what about bear calls? Well, simple process. It's the same concepts we just discussed, but slightly reversed. Here, I want to sell an out-of-the-money call, a strike price that's above the current stock price to get that better probability of success. Of course, so I'm not trading just a naked call. We buy a further out-of-the-money call, 1 strike or 2 strikes away, to receive the net credit. And in this case, it's a bear. It's a bear call credit. I want the stock to stay the same or move down. As long as the stock stays below both strike prices, we receive the maximum profit. Both calls expire worthless. We have to do nothing else. The net credit is ours, already deposited in our account. In this example, Apple at 153, 152, bouncing around that 153 price. Same expiration, January 18th, 9 days away. I might sell the 160 call for about 80 to 81 cents, and at the same time buy the 165 call for about 26, 27 cents. Total net credit would be about 54 cents at midpoint. But this is a 5-point spread. So the monetary risk is 446. My return on investment still at 12%, that 10, 12% we were seeing with the bull puts as well on Apple. If everything works out right, the stock stays below 160, 4 o'clock, Friday expiration, January 18th. Both calls expire. That monetary amount was already deposited in my account from the exchanges. Of course, may have to manage the position if it starts to move against me. I'm a couple strikes away. Only 7 points this time, but I'm a couple strikes away from the current stock price to get that better probability, having that lower delta, but the better probability that the stock will stay below my short call strike price at expiration. Now, why didn't I keep the same structure of a 2-point spread that we saw in the bull puts for our bear call example? Well, it simply comes down to strike price availability. On this particular security, once you get above the $150 price or $150 strikes, Apple only has 2.5-point strike differences. It's kind of weird when you look at a chain, right? You can see the 140, 141, 142, 43, 44, 45, 46, 47, 48, 49, 50, 52 and a half, 152 and a half, 155. So it jumps at that point. As I mentioned, I want to keep 2 points apart to have the availability to maybe roll just the short put up 1 if things start going against me based on my expectations as part of my management. So I showed a 5-point spread. If the 160 is threatened, I have the choice just to roll up to the 162.50 as a potential management. Might not be the one I do, but I have that availability without moving the 165. The same concepts apply, but reverse slightly. With a bear call, I want a stock that is bearish. I want to see a stock that is in a downtrend. Recent weakness, anything along those lines, and a continuing downtrend. I want a spread that is out of the money. On the call side, that means higher strikes. 1 or 2 strikes above current stock price. Low delta, as we mentioned, higher probability. Want a spread width that is manageable. Not only, I mean manageable as far as adjusting, but manageable for your goals, your expectations, and the monetary amount you're allocating to spread trading in your portfolio. In general, I do want to be shorter term, higher annualized return, shorter time frame. You can do the weeklies just 5 days out if you open a spread on Monday, if it matches your criteria, of course. 2 weeks out, 3 weeks out, a month out. It's not a good idea to do credit spreads that are 6 months out in time. You might do a different version of a debit spread. That's for a different conversation, of course. What do we look for? Again, here's our default settings for the bull put weeklies. Personally, we look for 8 to 17 days out in time. I do want Good net credit, good range out of the money, good probability as well, and some technical indicators. I want the stock to be below its 20-day or 50-day moving average. You can use EMAs, as I mentioned, for your stock analysis. Negative MACD cross, and again, avoiding stocks between now and expiration. But a bear call credit can work on any security that you're bearish on. It doesn't have to be our settings, of course. I'm just showing you the basics of what we look for based on the structure that works for a vertical credit spread, good range out of the money, manageable strike difference, the security moving in the direction we want for the bull or the bear spread as well. Okay, quick question that comes in. Let me do this first. Let me go to this next slide first. Basics for either strategy. Don't follow the news. Okay, some good news comes out for a stock and it peaks up 15% at the market open for some good news. You say, that's a good idea for a bull put. I'm going to go a couple strikes out of the money. What happens in the next 5 days when the news wanes off? Stock starts to pull back towards your strike prices. You don't want to potentially follow the news or the hot stocks. Never hold a spread trade through earnings. Never trade or hold a spread through earnings. No matter how bullish you are, positive earnings, or how negative you are for bearish earnings, the surprise can hurt you more than you consider. Stocks that offer options with higher premium, higher implied volatility, biotech stocks, things that have just been in the hot news, or something gold is moving actively. Higher implied volatility does not mean a better trade. Does it mean a better premium on individual options? Yes. Which also, since we're doing a spread, we're selling one that has an expiration date. We're buying one with the same expiration date at a further out of the money strike. Well, if my short option is overvalued or inflated from high IV, the option I'm buying is going to be inflated as well. It's a trade-off. But why do the options have higher IV and higher premium? Because of something coming up in the future or something that has recently happened that may cause the stock to fluctuate wildly. That is not the market, and that is not the security that you want for these structures. And now discipline is important as well. You don't want to overtrade. Okay? If you had $5,000 to invest, you don't want to buy stock and put it into a covered call, a collar, or a married put position, for example. And you don't want to buy 20 contracts of a long call and put $5,000 into a long call that can move against you. If you have a 5-point spread, you don't want to allocate the full $5,000 necessarily to that 5-point spread either. The monetary risk, the risk on the spread times the number of contracts you're planning on trading, in my personal opinion, should not represent more than 4 or 5% of your total portfolio value. So if the unexpected happens and you do suddenly find yourself at the maximum loss of that spread, you still have 95% of what you started off with in your entire portfolio to continue trading. As another oversight, overlooking basics here, didn't really write it here, but in general, we suggest that you don't allocate more than maybe 15 to 20% of your total portfolio to spread tradings because, in order to be successful, yes, there are investors who are profitable with spread trading, but at times you may have to stop. Swinging markets are not the best time for credit spreads, maybe even debit spreads, or Michael, related to your question to Iron Condors, which I'll get to in a minute. I didn't trade any bull put credit spreads through the end of 2018, from November into December, but I also didn't trade any bear calls at that time, with that portion of my portfolio. Why? Because we were seeing days where, yes, the Dow was down 600, the markets were pulled down several hundred points, and the next day it was back up a few hundred points. You're going to be managing trigger points from a bull put to a bear call left and right in that type of market. You looked really good on the bear call on the first day when the Dow was down 600 points and it pulled the entire market down, but the next day you're almost at your trigger point on that bear call because it rebounded 50 to 60% or more of what it lost. And then you have days that are 200, 300 up, getting closer to your trigger, and then yes, thankfully you see another 400 point down, but then it comes back up again. That's not the market for credit spreads, or especially iron condors, where you can lose in both directions. Now, other times you may have to change. Many of us may feel that the market as a whole is now coming back up, or that in general the market is bullish. We all know there's outside forces related to that. So if I'm trading bull put credit spreads and I'm going along and I've had 4 or 5 months of successes, but some news starts coming out, Fed announcements are coming up, things of that nature, I may change out of my bull puts to do bear calls because I want to follow the market, or stop, as I mentioned, bull puts and bear calls together. Now, to be successful, you will have to manage. Yes, we're looking for positions that maybe have an 80 to 85% probability of success. Maybe we can expect to be right 8 out of 10 times, 8.5 out of 10 times. But those spreads that offer that higher probability, you're typically looking at an 8 to 1 or 9 to 1 risk-reward ratio. We never want to take the full loss. We want to avoid that if possible. But sometimes the inevitable will happen. Things we can't control, we wake up in the morning and our underlying security is blown below both strike prices with a gap down or a gap up. It's really hard, very difficult to manage a spread once you hit a 70 or 80% loss or higher of the maximum you could occur. There are ways to potentially manage it, may not match your trading goals. It becomes very difficult. We want to be able to manage it before it gets too threatened. But you will have an experience where you take the full loss on a credit spread, and aside from rolling it out 6 to 8 months out in time and increasing the strike prices, you're not going to be able to repair it. You might just have to take that loss as part of the trading plan to make it back up later. A spread portfolio can offer wild swings in your portfolio, meaning that sometimes, as we talked about earlier, you may see declines as high as 30 to 40, maybe even 50% over time, even if you're trading both on separate stocks, bull puts or bear calls, and markets that are fluctuating. At the same time, you may see a 30 to 40% gain over a 4-month period if things are working out as you expected. Now, to Michael's quick question, I kind of glossed over it, but he says, is there an advantage to make a simple credit spread instead of an iron condor? The advantage is that hopefully you feel more confident in the direction of the market and the direction of your security. Meaning, if I'm neutral to bullish, why would I even want to trade a bear call? An iron condor, sorry, for those of you that don't know, is just a combination of a bull put credit, as we showed, same expiration, with a bear call credit spread on the same stock. I could combine the two. Actually, let me just go back a second. It's going to go all the way back to the beginning here while the screen is paused. Give me 1 second. All right, let's take a look. So what Michael's asking is, again, this goes beyond the basics, what we promised to discuss. Here's the 2 screenshots of our bull put credit spread and our bear call credit spread we illustrated on Apple. I combine the two. That's an iron condor. As long as the stock stays below 160 and above 144, all 4 options expire worthless. We keep the extra net credit. I get the credit from the bull put and the bear call. In December, November, was it a good idea to do iron condors? Absolutely not. You'd have lost on the bull puts. Wasn't a good time to do bull puts either. You would have been losing on the bull puts every time and had to manage them. I have not traded an iron condor since midway through 2016. Why? Because even if I set up a structure with the bull put, the market was doing exactly what? Well, for those 2 years, the market was pretty much going lower left to upper right. And it was doing it quickly, losing on 70 to 80% of the bear calls, even if I skewed it and made this 8% out of the money and this was only 4. Why have that? Why stand in the direction of the freight train? Just do bull puts. And in October, I missed October myself personally, I'll admit that freely. I had to manage some of my spreads in October, but I didn't do the bull puts. I didn't do bear calls either, but for November and then the recovery and then December and then a little recovery here, was this the time to be doing iron condors? No. Again, the bull put this time was being threatened. You were forced to manage that side, and the extra credit you're receiving from the bear call wasn't there. Okay? All right. And Michael, in my opinion, no. I'm going to answer you straight. In my opinion, no. We can argue it. I can show you examples that I've shown in other webinars. You'll see that in some of the other webinars we have for you. You said, I mean, isn't it better to get the credit on both sides, searching for sideways markets instead of trying to guess the direction? Okay, well, my first answer to you is no, because of what I experienced and would have experienced losses on Iron Condors from 2016 up to the beginning of 2018. It was better just to do bull puts. It really was. And then, of course, the first part of 2018, February 5th to 9th, got everyone scared. Bull puts lost in that time frame, but they're able to be managed. Iron Condors could have worked in the middle. Maybe would have outperformed bull put credit spreads, but Iron Condors would have lost more if you kept that strategy going through the last 3 months. If you can consistently find securities that don't move more than positive or negative 2% over a 14-day time period, maybe less than 1% over a 5-day time period, 2% over a 14-day time period, or stay within a range of plus or minus 3% over a 20 to 30-day time period, your Iron Condors might perform better. Market does not give me any security to feel that's the case, that there's going to be swings, of course, as you mentioned. So isn't it better to get the higher net credit up front? Yes, but in the Iron Condor, you're still looking at a 6-to-1, 7-to-1, 8-to-1 risk-reward ratio. I'm losing on a side that I would have been right on with the bull put, or I'm losing on a side I would have been right on just with the bear call. And net credit helped the loss a little bit, but I'm still taking a 6-to-1, 7-to-1 loss with the Iron Condor. Again, if you feel that you can consistently find stocks that, in my opinion, don't move more, let's call it 1.5, more than 1.5% up or down in a 5-day time period, more than 2.5% over a 14-day time period, 3 to 3.5% plus or minus over a 20 to 30-day time period, your Iron Condors will perform better. What do I mean by consistently? I mean finding stocks that have that movement in that time frame greater than 75% of the time, probably greater than 80%. That way Iron Condors would outperform. That being said, Michael, I'm not trying to talk down to Iron Condors completely. One of my 8 ways to manage a position if it's slightly threatened but I think it's going to recover, I will convert my bull put to an Iron Condor by adding the bear call to give me a little bit more cushion, a little bit better break even on the upper and lower side, but remembering now I have 2 ways to lose. That's key. All right. Speaking of which, what I mentioned to Michael and what I mentioned to everyone, those more detailed webinars on debit spreads versus credit spreads, how to be successful with spread trades, managing your spread positions, and 8 ways to manage a bull put credit spread. And there's also a webinar on 8 ways to manage a bear call. For the more in-depth, beyond the basics, just go to powerup.com/webinars.asp. It's a public page. Click on the Option Strategies tab, and then you'll be able to see those webinars right there for you. And you can watch those presentations that go more in depth into credit spreads and debit spreads and the benefits of parity trade, comparing one to the other before you make a position. Our thoughts on expectations, more in depth on the structure, criteria, historical breakdown for bull and bear spreads, how to be successful with spread trades. Our preferred 7 to 8 ways to manage credit or debit spreads, and then the full webinar on the 8 ways we look at to manage the bull put spreads. As Michael mentioned, one of them is, of course, to buy to close the short, leave the long open. If you're in a bear or bull and it starts to move against you, think it's going to continue in that trend. Having the ability to roll one strike, plus 6 other ways to manage, including the pendulum adjustment, to change a credit to a debit spread while still having a profit without having to take a loss on the position potentially as well. Now, we all know there's thousands, 5,000, 4,500, 800, 4,800 optionable stocks, ETFs, indexes, 2 times, 3 times ETFs, inverses, and everything along those lines. We talked about how the pros and cons of a 1-point spread versus a 2 versus a 5 and how it has to match your criteria. We talked about looking for the stocks that are showing the right trend in the right direction for whichever strategy you choose, or perhaps even an Iron Condor in Michael's case. Well, all of that's available at Power Options. I showed you the criteria we use for our default weeklies for bull puts and bear calls. And you can take a 14-day trial to Power Options with no credit card required. Just go to powerop.com, put in your name and email address. You can look at our defaults, or you can create your own. You can choose just to look at standard ETFs and indexes to identify bull puts, bear calls, or even Iron Condors with the return, probability, minimum net credit, strike difference, all available at your fingertips. So you control what spreads you're seeing across the universe of options. You know exactly why those spreads appeared. You have better confidence going forward as to matching the structure you want for your portfolio, your goals, and your expectations for the spread portion of your portfolio as well. Now, you may have other questions that you didn't ask during today's presentation or we didn't get to. As always, feel free to contact me at any time. You can call us here at Power Options during market hours at 302-992-7971. You could always email me to support@powerop.com. And remember, if you're currently on a trial, 14-day trial, or you're a subscriber, you can always schedule one of those free coaching sessions, which is a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site, answer any questions you have about strategy, management, and more. Can't give you direct trading advice. Speaking of which, today's presentation on the credit spread basics, which we delved away from a little bit, I do apologize, but the examples we showed on Apple were examples for theoretical and basic structure only. I am not bullish or bearish on Apple. I am currently not in a bull put or a bear call or planning on opening a bull put or a bear call on Apple at this time. These were not recommendations or suggestions. These were just the structures I would look for if I were to open a credit spread at this time on Apple, bullish or bearish, or maybe the Condor combination, combining the two as well. Options do involve risk, may not be for everyone. This presentation was designed to show you the basic structure and highlight some of the risks that exist with the spread trades, not to make any recommendations on which securities to trade on credit spreads, bull or bear. But if I am opening a bull put credit spread this week or next week, I can tell you that it's going to follow the default criteria that we have there in the bull put credit spread search on Power Options or the bear call credit spread search based on my market sentiment at that time. Thank you, ladies and gentlemen, for joining me for Credit Spreads the Basics. I hope you got some useful information out of today's material, and I hope to see you online at one of our next upcoming live webinars. Take care, everyone. Good night. I'll send you an email when today's presentation has been archived and posted to the webinars page.